After a year of, let's face it, unprecedented hype in artificial intelligence, I think it's time for a more sober look. We need to figure out where the real sustainable value might actually be found. So today, we're going to cut through some of that noise and really analyze the key tensions shaping the AI sector as we head into the new year. All right, before we dive in, the standard but very important disclaimer. What you're about to hear is my personal analytical framework. It is not and should not be taken as a recommendation to buy or sell any particular security.
So here's our roadmap. We're going to start at the very foundation, with the hardware giant Nvidia and the competitive pressures it's starting to face. Then we'll zoom out a bit, look at market valuations, and then see how AI is creating these ripple effects in the real economy. And we'll wrap up with the key questions that I think will really define this next phase.
Well, 2023 was undoubtedly the year AI went mainstream. The question isn't if it's going to change the world anymore. We know it will. The real question is who is actually going to profit from that change. You see, we're at a crossroads. The initial gold rush is tapering off, and now the really hard work of building lasting, sustainable value begins.
You know, to really understand the AI market, you have to start with Nvidia. I mean, they're providing the picks and shovels for this modern-day gold rush. But their absolute dominance brings this core tension right into focus. Is this explosive demand for their chips actually sustainable, or is the market setting itself up for a major correction?
So it all boils down to this fundamental balance. On one side, you have the bull case, right? An almost insatiable demand for GPUs, as every single major player is racing to build out their AI infrastructure. But on the other side, the bear case, a very tangible risk that these same clients are over-ordering, creating a supply glut that could absolutely crush prices and margins.
You know, this overstocking risk, that's the ghost in the machine for investors. When you hear major cloud providers say their biggest bottleneck isn't even getting enough chips, but finding enough electricity to power them, well, that should give everyone a moment of pause. Now, for today, the order books are still full, but it's a critical warning sign of a potential structural shift down the road.
And this brings us right to the valuation. At roughly 21 times forward earnings estimates, the price, it doesn't seem outrageous if this incredible growth just keeps on going, but, and this is a big but, it offers very little cushion if that overstocking scenario actually happens. It's a valuation that absolutely demands perfect execution.
But the risk for Nvidia isn't just a potential drop in demand. There's a new threat emerging, and it's not from the old rivals like Intel or AMD. No, it's coming from their biggest customers, who are now looking to build their own way out of depending on them. This really leads to a multi-billion-dollar question. Why would giants like Google, Amazon, and Meta pour so much money into designing their own custom chips? And these aren't just general-purpose chips. We're talking about ASICs, application-specific integrated circuits. They're designed to do one thing and do it exceptionally well. So what's the strategic payoff?
Well, when you boil it all down, it comes to three key things. First, it's about strategic control over their own destiny and their own supply chain. Second, it's cost efficiency, which becomes absolutely critical when you're operating at their massive scale. And third, it's the ability to create custom performance, to optimize chips for their own unique workloads.
And here is the critical nuance. These custom chips don't need to be a Swiss Army knife that replaces Nvidia entirely. Not at all. They just need to be the perfect scalpel for one specific task. So by peeling off individual workloads, think video transcoding or language model inference, they can, over time, create a death by 1,000 cuts, putting real pressure on Nvidia's market share and its premium price.
Now, all this uncertainty in the hardware layer is creating a fascinating disconnect in the financial markets. We're essentially seeing a tale of two entirely different valuation stories for AI companies, depending on one simple thing, whether they're public or private.
Just take a look at this comparison. You have Databricks, still private, reportedly being valued at around $130 billion. At the same time, its closest public competitor, Snowflake, is trading with a market cap of around $80 billion. That is a $50 billion difference for companies that are chasing these same customers with very similar technology. It's a massive, glaring gap.
A valuation gap like that, and it's not unique to Databricks, by the way, it signals that something is out of place. It raises a really fundamental question. Are private market investors seeing some future that the public markets are completely missing? Or is the public market skepticism a sign of a bubble that's just about to pop? One of these markets is wrong, and the resolution? Well, it's probably going to be turbulent.
Okay, so let's move beyond the chip wars and these wild market valuations for a moment. How is all this AI investment actually translating into real-world economic impact? Let's try to connect these threads back to corporate profits, back to the bottom line.
You know, it's plausible that this wave of corporate layoffs we've been seeing isn't a sign of broad economic weakness. I mean, with a strong consumer and falling interest rates, it seems a little counterintuitive, doesn't it? I would argue this may very well be the first wave of AI-enabled efficiency transforming businesses from the inside out.
Amazon gives us a powerful case study here. Even with all their heavy investments, the math is pretty compelling. Let's just assume 30% growth in their cloud business, AWS, and combine that with just a modest margin expansion in retail from AI efficiencies. That alone points to roughly 20% profit growth. And then you add in the wild card. A long overdue price hike for Prime could inject another $3 to $5 billion straight to the bottom line.
So with all these powerful forces at play, what are the crucial questions we need to keep monitoring as we move forward? Because believe me, the half-life of any narrative in AI is incredibly short. We have to stay disciplined and focused on these fundamental questions. First, the GPU demand cycle. How sustainable is this boom really? Second, that ASIC threat. When does it move from a concept to a material impact? Third, the valuation riddle. What gives first, public or private markets? And finally, the economic impact. How quickly does all this show up in broad corporate earnings?
And this brings us to the final, and I think the most crucial question, the one that's going to define the next decade of technology. After this initial infrastructure build-out, where will the enduring value actually be captured? Is it going to be with the hardware providers like Nvidia, the foundational model creators like OpenAI, or the thousands of companies building applications on top of it all? That right there remains the multi-trillion-dollar question.